more of these use cases being tried. The experimentation, we're going to see this year have a ton of it, whether it be the middleware providers or whether it be additional banks coming on board. I think this year is the year of experimentation. The following year after that is going to be sussing out how do we put the protections in place from all the things that happened during the experimentation phase. And then how do we get the market and consumer adoption, and how do we expand the distribution channel? Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. Welcome to another episode of Fintech Confidential's Uncut, where we talk about subjects without any limitations, without any restrictions, and truly share what we're thinking, where we're getting those thoughts from, and how we're thinking about all of these subjects. Today's topic is going to be pay by bank. And we're very lucky to have a guest here today who knows this very, very well. We have Dean Nolan, and he's the managing director of commercial payments at SRM, an independent advisory firm with over 25 years of experience in the payments and financial services industry. He's held various leadership roles in strategy, innovation, product management, and sales. Prior to SRM, he was a vice president at Fifth Third Bank and held senior positions at MasterCard, First Data, Wells Fargo Bank, and Bank of America. Dean is an active participant in the payments community, serving as a speaker, work group chair, executive director in various organizations. He holds an MBA from Marquette. He holds an MBA from Marquette University and a BA from University of Wisconsin-Milwaukee. Dean lives in Charlotte, North Carolina. And as always, we're happy to have you on, Dean. And Matt, welcome back.
Thank you.
Thanks.
Good to meet you, Dean.
Likewise, Matt and Ted, looking forward to today's conversation.
So one of the what we talked about was in the intro is the fact that we are going to be diving into pay by bank, and everybody seems to have a slightly different definition of what pay by bank is. And what I'd like to do is Dean, with you being the guest today, I'd love for you to share with us what your definition of pay by bank is. And then we'll have Matt, and then I'll follow in and fill in any variations that we feel differently on this.
Yes, I think the definition I tend to work with is pay by bank is a subset of account to account payments. And it's really the subset that focuses on allowing consumers to make payments for goods and services, fund those payments directly from their bank accounts, and that those payments are made directly to the merchant or service provider without the need for a debit or credit card.
Awesome. And that piece of it really starts to look at, I think it's interesting you say without debit or credit card, because a lot of the debit cards are tied directly to the bank account. So we'll talk about that in a little bit, but Matt, I'd love to get your perspective as well.
Yeah, I think there's a very literal interpretation of what pay by bank means, which is person, let's just say this is a consumer context, can send money from their bank account to another bank account directly with no intermediary. That to me is the real core of what pay by bank is meant to be. And for a lot of different reasons, some of them I think very necessary, some of them perhaps just opportunistic capitalist strategic planning that companies kind of insert themselves in between and act as helpful gatekeepers. But the whole point, pay by bank from the consumer's perspective, is I should be able to send the money where I want it to go, and no one should touch it in between or take any value out of it.
Yeah. And if I just add to that, it's like, I think it's interesting what you say, and I can see that definition as well. And I think to me, one of the most interesting things about pay by bank is it really isn't new, right? Because before you had debit or credit cards, people were doing pay by bank. One could argue a check is a form of pay by bank. Go back to, that goes back to the 17th century when those were being made. Wires could be considered pay by bank. ACH could be considered pay by bank. Those are, 1870 or 50, 60 years old. I think the reason that we're here today is it's kind of how the new technologies, APIs, have impacted what's happening. And then also new payment mechanisms like instant payments, FedNow and RTP are kind of changing the dynamics of pay by bank and Matt, allowing what you're talking about to happen in a real-time technology driven environment rather than a 2-day delay or going back to what checks used to, going back to checks. So, so in that perspective, it's both new and old at the same time. That's one of the things I find most fascinating about the space.
And just it makes sense to require in the definition that the payment is occurring in near real time. Like say if we're trying to get to a definition of what is pay by bank, would we agree that it's a consumer initiated payment that does not require an intermediary to move money between accounts in real time?
I'll go with the consumer initiated and in real time. And I think for real time is good for today. I think there's got to be an intermediary of some sort to connect the two banks, right? So even if you're talking just straight APIs going across the internet, you've got intermediaries who are participating in that transaction. So something's got to happen to connect the bank. So that's why I'm a little bit squishier on the without intermediary. But I do think your point about the cost that gets taken out of the payment, maybe it's no cost taken out, is too absolute. Maybe it needs to be more, minimizing the cost that's taken out of the payment. Again, that might be one of the new interesting things that starting to evolve, and thoughts about how to minimize the costs that are associated with those intermediaries.
And just for everybody's understanding, we're going to be focusing on U.S. based bank to pay by bank today. I mean, there are other technologies across the world that have, heck, they've been doing real time payments in Europe for some time. And then of course you've got India and Brazil that are really playing a part in the global sphere, but we're going to stay focused on US. And, honestly, where I fit somewhere outside of your guys' circle, because I'm looking at if I don't have, for me, pay by bank is when it goes from one bank account, my bank account, to the person's bank account that I'm paying, without inserting some sort of credit facility between the two. That to me is pay by bank. And like you mentioned, Dean, ACH falls into that category. Wire falls into that category. Heck, RTP and FedNow fall into that category. And even for me, the push to card and the push via debit card, like what Cash App uses, to me also falls into the pay by bank, because it's leveraging that debit card information to do basically what comes down to a pinless debit transaction. And so that's why I would bring that piece of it into it. Matt, how would you push that one outside and say, no, that's a card brand product. It's got to stay out there. Like, help me understand.
I don't know. I think it's an interesting twist. You seem to, in that list of things that you include as pay by bank, not to agree with the premise that real time is critical. So I think that probably I want to clarify, is that your perspective? Like, to me is not real time. It's getting faster. It has same day. There's multiple settlement windows, but it is not a real time system. So I think it's just a question of if we define like as a key ingredient that the delivery of the payment to the recipient occurs in near real time, I would say, yeah, some of those don't qualify. Maybe we could just clarify that piece, because I do have other thoughts about the facility for settlement right in between them.
Yeah. So the reason why, today's subject is pay by bank. It isn't pay near real time by bank, right? And so that's why I was going a little bit of broader discussion, is because pay by bank, as Dean mentioned, has been around forever. It's just evolved, and each thing has gotten more advanced and a little bit faster, and more advanced, a little bit faster, and more advanced, a little bit faster. And now we're to the point where it's near real time. And so that's the perspective that I was taking from it.
Yeah. So let's say then, we mentioned consumer initiated as a kind of a critical piece. In an ACH, you could have a debit or a credit. So I could have a merchant that's debiting my bank account. I'm not initiating, really. I might have given authorization. You could call that initiating, but it's really the business in this case, which is with authorization, pulling funds from my bank account. So I'm just questioning if any of the previous agreements that we had established actually hold true if we take this approach.
Yeah, no, and that's a good point. Looking at it from did the customer press the button to, or gave the okay at the moment in which the request for payment or the push of payment happens, then yeah, I would agree with you that ACH doesn't fall into that. Wire, I think, would, but check wouldn't, in my perspective.
Yeah. Check would not qualify
Would not.
as consumer initiated. You say no?
I see where you guys are going on this, and it is one of the reasons I think this definition is so difficult, right? I mean, you could take it to the next degree and say, even if I pay with my credit card, ultimately I pay off my credit card with checking account funds. So it really was money that came out of my checking account that just got delayed for 30 days because I was using the free float on my credit card to get it.
Exactly.
I would say, what I
so everything's paid by bank.
Yeah. Sure. What I throw out there is, maybe for today, we do focus, Matt, closer to the definition you're saying with it's consumer originated and it's something that is happening real time or near real time. So I think that's where the new excitement around this has come. And, I've sat on discussions with people talking about check processing and ACH and wires. And, there's been a lot of those for the long time, but I think maybe today we could focus more on what's happening in more of the instant payment space and API and what's happening to potentially change the commerce environment. That might be an agreeable topic, or at least agreeable definition for the next, 45 minutes or so of this call.
Yeah. I will agree with that too. But I think by doing that, what that forces us to have to do is really look at what are the nuances of these types of pieces. And the one that I really want to get Matt's perspective on is that now that we're talking about near real time and we're talking bank to bank, there possible some sort of intermediary where it's the clearinghouse or Fed, or a card brand. How Matt, his feelings around the push to card, and then Dean, I'd love to get yours as well.
Yeah. Just a full disclosure. If anyone doesn't know, I managed the Visa Direct product team for several years. And so push to card is something I definitely, love and is near and dear to my heart. So there's going to be bias in my response. There's bias in any response, but especially there. No, and I think what you're pointing to, there, Ted, is like, and this is the way we thought about it at Visa, is the card is just a credential that helps to route money from one endpoint to another endpoint. And in the case of, like, say, sending money to an account, using a card as the credential to identify where that funds should go, I would agree. The one thing I think is maybe important for us to also clarify, as far as like just drawing like where's the box we're going to sort of focus on, is if it's about a consumer buying something, right? Pushing money from a consumer to a business. While Visa Direct and MasterCard Send and other like push or platforms can support use cases there, they're not designed for that. And so I think there's also some definite like trade-offs around like where it works well and where it doesn't work well. It can definitely be part of a solution. But I think it's, I guess, in addition to kind of just choosing about where we restrict the scope in the prior like thread that we just kind of tied off, I think it would be good to also just clarify like there's person-to-person payments that facilitate money movement in lots of different ways, and then there's disbursements that also facilitate money moving from businesses to consumers in a number of different ways. In my mind, pay by bank, when people say pay by bank, what they're thinking about is I don't want to have to pay credit card interchange. I want to be able to, and from a merchant perspective, I want to save money. So I want to offer consumers the option to pay by bank so that I don't have to pay as much fees. So that's what I think of as really being what determines what goes in the box, is merchants think they can save money by avoiding traditional credit card interchange and debit card interchange.
Yeah, I when you were talking about Visa Direct, in full disclosure, I spent most of my energy focused on RTP and FedNow payments and a little less so on Visa Direct. But I always viewed Visa Direct, similar to how you were describing it. And, one of the characteristics of pay by bank, especially if you're talking consumer to business, is if as a business, you don't want every consumer out there to know your bank account number. right? So there's usually some intermediary that sits in between, whether it's a directory model or a card number, like a Visa or MasterCard card number that kind of masks that bank account number. So there's some privacy there. Or, some things happening like that. I may have been talking more in a P2P instance there, but I think you get the point.
Yeah.
So
Yeah.
I do see, so I think there's always something in there in the directory models or the card number or some type of tokenization or something happening to anonymize that business accounts number, just because you don't want that exposed to millions of consumers. It's just going to create too many problems for lots of problems. But I do agree. I definitely see Visa Direct and MasterCard Send as, products that fit in this space.
Well, see, I don't. That's what I was trying to clarify. I don't see them fitting in the space when we're describing, like a large merchant accepting payments. Visa Direct and MasterCard Send is not meant for them. A tiny like seller, like you or me at the, if we were setting up a table to sell, Girl Scout cookies are being sold in my neighborhood now. In theory, I could set up an account where you could just push me money, to my debit card. And then it depends on the business having a debit card that they can publish. And last time I checked, Verizon doesn't have one debit card that it could share with everyone to receive money into their bank account. And so it's like, I think it's a fit for purpose kind of a question. Like the technology is there to solve a particular problem. And then there are, I think, things that it's really good at. And then there are things that it isn't as good at, because not every tool can solve everything. Yeah.
Okay. Thanks for that clarification. And then I do agree with you. And I do agree too, your point about fit for purpose. I think that's going to end up being something we're going to talk about on Pay by Bank as we get into today as well, because it is definitely something where it's fit for purpose, and you have to find what that purpose is and where it makes sense over what exists today. Because, in the US market, consumers are well served by the number of payment choices they have available, right? So something new like instant payments, something new like instant payments powered Pay by Bank, it's going to have an impact they're going to have impact in high value areas where the value proposition solves a use case better than what exists today. But it's not, I'm not sure it will make other payments go away. And, I go back to my check comment before, checks have been around for hundreds of years and we keep trying to get rid of them, but they keep persisting. And I'm not sure in our lifetime if we'll see checks finally go away unless there's some government mandate to say make them go away.
Yeah. And there are still billions of paper checks that go through all the systems today. A lot of people don't realize a lot of times when you do a bill payment through your bank, guess what? That turns into a paper check and gets sent off in the mail. And, that's the way that it's still done. But what I want to do is talk about, we already talked about fit for purpose use cases, but in the US, when you start to look at the pay by bank, traction is nearly non-existent in the US right now. When you talk about the definition we just defined of consumer to merchant,
initiated
by the consumer.
Payments to a merchant that occur in near real time, it is virtually zero.
But I believe
payments
a lot
that
of
are
that
debited from an account is huge, right? And so that's why I think it's important to distinguish. Like if you just switch that one little assumption, say, pre-authorized debits, is that part of this definition? Well, that's probably one of the biggest sources of value exchange that we currently have. Like almost many recurring payments happen with that methodology, right? The higher ticket items in particular. So like your utility bill, your insurance payments, like mix of card and ACE for higher ticket items is definitely, more in favor of a debit transaction, ACH debit transaction versus a card transaction. A digital subscription that's $6.99 a month, $12.99 a month, like that's heavily card oriented. And one of the things that we're seeing, the place where I currently work, VGS, is a lot of interest in that side of the market, in lower ticket being able to take advantage of Pay by Bank, right? So can companies that started off with a heavy focus on card as their sole method of receiving payment, can they offer consumers a different choice? And if they do, what's the likelihood that they'll choose it? And what do they need to kind of like believe to kind of invest in a program like that?
I mean, a perfect example of that is, I have Verizon as my wireless carrier. I'm sorry to those who have AT&T and experienced the blackout last week. But
Verizon had
I
a
look at
blackout
that
too?
and they no, just AT&T.
Oh,
Not
AT&T. Okay. Sorry. Yeah.
Verizon. Yeah. But I look at it and they gave me three choices. If I use my credit card on file, I don't get a discount. But if I use my debit card, I get a little bit of a discount. If I do ACH, automated ACH withdrawal, then I get an even bigger discount. And when I looked at it and of course I did this, I looked at the points value of the card that I use for my Verizon payment versus the discount, and the points were worth more than the discount. So I'm like, okay, fine. I'll just keep using the points from my reward card. And so I think that's going to be one of the things that, will continue to be one of the things, because we are such a heavily entrenched card people, I guess. Like that's our culture, very, very heavily in our culture to really leverage the cards, that it's going to be harder to move out of the card arena. It's going to have to be just as easy, if not easier, than a card payment.
What is easier than a card payment you've already set up, though, right? I mean, if you've already enrolled with a card, you need to do a lot more than make it easy to switch to a bank. You need to give a reason, like an incentive. And what you just illustrated is that even a discount wasn't sufficient, right? So that just speaks to the amount of inertia that a merchant has to overcome to change the paradigm and affect, consumer behavior to kind of move in a new direction.
I think your example, Ted, is really good too of, what you talked about was the happy path. The payment went through right. The service you bought was exactly what you thought it was. And you had three options: credit, debit, and ACH. And in that happy path, you were able to look at the value you got and said, reward the card, best value, put the payment there. When you start to go down the unhappy path and you've got a dispute involved or a service problem, then the difference between debit, credit, and ACH becomes more apparent. If it's a credit card purchase and you bought something, you signed up for a service and say they charged you beyond the length of your service contract. Not that Verizon would do that, but there's some industries where that's more prevalent. Well, if it's a credit card, you care about it a little bit less because it's not your money. If it's a debit card, well, wait a minute, they just took your money and now you're fighting to get your money back. It's a different level of engagement by the consumer. Worst case, though, you can shut down your debit card and make them go away. Then you just got to fight to get the money back. If it's an ACH, well, not only is it your money, but they're attached to your bank account. So if you're trying to fight that one, you may have to shut down your bank account. And that's a big deal, right? Because that affects your direct deposit and everything else. So even though it sounds like a happy path, you can just look at rewards. If you're one of those people who have been in the industry or one of those people who've experienced the unhappy path, there's a big difference between those three on that side of the equation. And again, that's going to relate to pay by bank too, because that same scenario of the protections you get at the point of sale with pay by bank with a card versus a pay by bank is different. But again, it's happy path versus unhappy path. And how do you want to look at those two?
If we went back to our original definition though, Dean, and said, we're only going to look at the ones that we consider to be consumer initiated. And there's a couple of models where I think that, and if it's consumer initiated, where I chose who gets to have the money, right? It's up to me. And I'm the one that directed it.
When do I release it?
Yep.
Yeah. In that scenario, and there's a model for that exists even with RTP, right? With a request for payment, with which you have an option to approve or not approve.
Yep.
So they don't actually have the authorization to take your money. And so I think this is one of the reasons why I think it's important to focus on what I think the potential value of the pay by bank that I was focused on at the start. All for these are the reasons, because if you take away one of them, then you're left with, exactly what you described. Not great, right? Very little control, hard to fight back. The rules are not as clear. Notcha does have rules, like they exist. The banks attempt to follow those rules. It is different than when you go through the networks, which have very, very clear dispute resolution and chargeback, processes and requirements. I think most people feel if something bad happens, with a card payment that wasn't my fault, I'm not going to be responsible for it. And I think generally speaking, that is true, right? There's a zero liability posture. A lot of that is funded by, because of interchange, banks and networks can afford to eat some losses and have a big back office that can handle disputes and chargebacks and negotiating between all these parties, which costs money. If you take away interchange and you just go like, well, now we've reached the nirvana of real-time point-to-point accounts with nobody in between. And again, I actually removed that intermediary thing, like intentionally, because I think it's part of the myth of what pay by bank is versus what it really is going to need to be to protect consumers. Once you add back all the protections, there's not much difference, logistically speaking, between a pay by bank flow and a traditional like debit purchase. They're pretty much the same thing.
Yeah, if you add the protections, then I would agree with you. We're not there.
Well, they don't
yet,
exist yet, right? So we don't even know exactly what they're going to cost, because in many cases, like take, for example, Zelle is not quite pay by bank, but it's sort of like pretty close, I think, to what pay by bank would be if more people were using it.
It rides on the RTP rails, so wouldn't it then be considered?
Yeah, sure. We could say, let's just say for the, like, I just didn't want to create a total fork in the conversation, but I've had an experience with Zelle where money got sent to a place where it wasn't supposed to go, and changing that back to what it was supposed to be was not possible. It just couldn't happen. Based on the way that the rules are set, based on the bank's incentives or lack of incentives to address the problem, right? And so
now, was that sent to a party you didn't want to send it to?
No, I got the money. I received the money.
Well, you got the money.
I wasn't supposed to get it. It was fraud, right? Somebody had stolen someone's card and had pushed money to me that I wanted to not give back to the fraudster. But I also didn't want to keep it because it's not my money. I wanted to just like say, hey, bank, return this to the actual account holder of whatever payment instrument was used to fund that Zelle transaction. Because I can't see it, right? I don't know how it was funded, but it was just very clear from all the interactions with this individual that this was not a legitimate, like, oops, I sent the money to the wrong place. Can you just send it back to me? Like, it's a common fraud tactic. And yeah, my bank was just sort of like, yeah, just send it back to them. I said, no, you don't understand. Like that person who gave me this money, I don't think they're legitimate. I don't want to be part of that. And I wanted them to resolve it, right? I just didn't want to be in the middle. And they weren't able to, right? They just simply couldn't. They didn't have a way to facilitate that. I kept them in mind.
And that kind of brings it to, that's the one of the pieces around the person to person piece of it. What I've been hearing kind of between both of you is really the pay by bank today that we have today, and the options that are coming out through RTP and FedNow. The use cases for those are best fit for known entities that you trust or essential services that you have little to no choice because it has to be done by a certain date and time.
Yeah.
What I mean by that is utilities or something of that nature.
Is there a service in the United States that fits this definition that's live today? If there is, I've never used it. My bank doesn't enable me to send money in real time to another bank account, where I just tell them, send this money to that account in real time using RTP or FedNow. Like, my bank doesn't enable me to do that. Maybe another bank does, but mine doesn't. Like, I couldn't even if I wanted to.
So mine does.
Go ahead, Ted.
So mine does. I use USAA, and they actually use, I can't remember which one it is.
They use ACH. She'll allow you to do real time.
When I decide that I want to transfer from one bank account to the other,
your own account,
my own 2 accounts that I own, when I transfer, it automatically, like, it shows up within minutes on the other balance
slightly
sheet.
Different, right? That's an account to account, like me to me transfer. I think that I can do also. What I'm talking about is, like, I want to designate, just send this money to that account. Because when you set that up, you had to verify the other account. You had to show that it was your account. You wouldn't just be able to send that to me, for example.
Yeah, that makes sense. And Ted, I'd also say in that scenario, depending on who your bank was, sometimes that's still happening as an ACH, but they just trust you and they're willing to take the risk to let that money go for 2 days. Right? Now, obviously, for it to get to the other side and them to book it right away, it has to be RTP, but there's scenarios there, that just kind of jump in. So it gets really fascinating. You had also brought up Zelle, and that's probably where my brain still was. The vast majority of Zelle transactions are settled via ACH, not RTP.
Right.
The banks just have a messaging network that runs through Zelle that lets them know that, Ted's paying Matt. So Ted's bank takes the money out of his account. Matt's bank puts the money in, but the money between the banks doesn't move for a couple of days.
Yeah. It's post facto, right?
Yeah.
So they're guaranteeing the funds based on the message, and then the banks have to settle. In many cases, bilaterally, right? They settle directly with each other.
Yep.
In a gross settlement. They don't even do a net settlement.
Yeah. So the settlement that happened, to your point, Matt, the settlement that happens behind the scenes on these payments is much more complicated than it's being presented to the consumers who make it look like it's real time. And I think that's also going to play into the fact is, when we as we talk about pay by bank and get back to that dialogue again, there's a lot of scenarios that have to come into play and move the money. And RTP and FedNow do offer that real-time gross settlement that allows that transaction to happen. The money moves not only between you and the business or you and me, but it also moves between our banks in real time. And that then adds that different perspective and differentiating perspective that makes a big deal for certain members in the ecosystem. Probably not for consumers because they still think everything's moving in real time anyways.
Why do you think the banks haven't exposed the ability for us to just send money in real time wherever we want, whenever we want?
They haven't figured out how to manage
for $1.
the
Like
potential
RTP and
fraud.
FedNow can do this today for 70% of bank accounts.
But just kind of like what you were talking about with your Zelle, from my perspective, somebody sent you money that really wasn't the person, but they had access to the credentials. And if you were leveraging
An alias in that case, an email address.
Zelle, but they had that they did an account takeover of some sort. They got the credentials. They were able to push those to you. And this is the same issue that I believe that the banks are running into, is that the ability to monitor and act on transactions that are deemed fraudulent or not initiated truly by the individual that has been KYC, KYB'd, or KYC AML'd. All that stuff hasn't been done. So they don't have the ability to do that. So that's why the batch process that you were just talking about is a really big deal. And I've actually had a conversation with a couple financial institutions that want to give the consumer to business RTP functionality, but they're stuck with this risk profile that they haven't been able to figure out, how do we do it without being batch focused?
Yeah. I'd answer your question, Matt, and say, in terms of the moving the money between the 70% of the accounts that are there, right now, businesses are able to push money to consumers or other businesses pretty regularly down that channel. And that's where most of that's happening today. Yep. Or it can be disbursement side. On the consumer side, the consumer paying a business, a little bit more complicated because you've got additional regulations on the consumer that have to be applied to the consumer as a sender versus the business as a sender. And I think some of that gets into making sure that the banks are comfortable with meeting those regulations. Some of it gets into making sure that the transactions themselves have the appropriate data to allow the banks to make all those decisions. And I'll get into that example in one more second here. The last piece of this is the request for payment. And that's the scenario where, in that case, you initiate a request for payment. The consumer then has to log on, approve that request to push the money. In that scenario, that itself is, the clearinghouse is doing some of that in a limited fashion. They've got permitted use cases and they've got things that they're built around that. All of that is really built around making sure that the right controls are in place to make sure that when someone's requesting money from you, it's a legitimate request, right? Because what will happen is, if it's an illegitimate request and you respond to it, even though technically in a request for payment environment and in an instant payment environment, that should be treated like cash. And if you set it to go, the money goes. Not in the U.S. environment, especially U.S. regulatory environment, there's some uncertainty about whether you have a right to pull that money back. And now the banks have to figure that out. And that's where there's caution being put in place by the banks to make sure that the right mechanisms are in place to protect the consumers for those unhappy path transactions like we talked about before, Ted.
Well, you just talked about something that has really the UK ran into a lot with their real-time payments problem. Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. And they were finding that what was happening is that they were getting requests. Someone would find, and I'm just overgeneralizing, but they would find out that my landscaper was, Joe's Landscaping, and they knew that. So what they do is they'd send a request for payment for Joe's Landscaping at the time that he's working on my yard, which wasn't actually coming from Joe's Landscaping, but it was another account, the Joe Landscaping that was there. It was coming from another Joe's Landscaping. And so they would request for payment. They'd send the payment, and then Joe's Landscaping that was actually there would say, hey, you never paid me. They're like, no, look, I paid you. And then when they would do all of the looking, then they would find out that, oh, that's somebody else that posed as Joe's Landscaping and got that funds. And I think that's one of the things that, as you just mentioned with the clearinghouse and being very specific on their use cases, is to not repeat the same mistakes that have happened elsewhere in the world.
100% agree on that. So yeah. So from the outside, it looks like the industry is moving slow, but I think on the inside, what's really happening is they're trying to move smart and avoid those mistakes. But sometimes, it all depends which way you're looking at which side of the coin you're looking at.
Are they moving smart, or are they just not moving much? Because I question the incentives here, right? Like is there an incentive for? I think there's a lot to overcome. Right. There's a lot of problems to solve. There's a lot of risks to take on. There's a lot of money you got to spend, people you got to hire. Why, if I'm a bank, right? And I've worked at JP Morgan, Wells Fargo, right? I can try to put that hat back on and ask myself, why do I want to make this a priority? Right. And I think,
why do I make it easy to disperse my deposits faster?
Well, but also why do I want? I have ways that I can enable my customers to spend money safely that the customer is happy with and that I understand. Why mess with that? Right. I'm a bank, and I'm saying to myself, like, do I really see an incentive here for me to put all this infrastructure in place? Nobody's clamoring for it, except the payment nerds out here like us who are always eager to try new things.
Yes, we like to do that. One of the things that I've heard
who's
from
taken to the streets to
of,
say, let me do this. Sorry, I talked over you, Ted. I think my network connection was laggy a little bit.
It's okay. No worries. I've heard from community bankers that they believe that this is something that will allow them to increase their deposits if they were able to offer it in a way that differentiates themselves from the big banks, the top 100, right? And so that's the way that they're trying to understand, how do I offer this out to my community in a way that provides additional value to my community, within my community, to continue to grow my community deposits so that I can do all the other stuff. And I think that's a lot of the perspectives. They're trying to figure out, how do they do that to better serve the community?
Yeah. But who in their community is saying, I really am struggling because I can't instantly send money from my phone to a business? Like where's that showing up in their sort of like customer feedback that's saying that's a problem? I'm not able to pay merchants with my debit card or my credit card or with a recurring ACH. So
what I've heard is that a lot of these merchants have decided to do what are we supposed to call it now? It's not cash discount. It's not
surcharge.
I mean, they don't call it surcharge. Dual pricing, whatever you want to call it, right?
Like what you were describing earlier about Verizon giving you incentives to change payment methods,
right?
Which you elected not to use, even though you could have, right?
Correct.
That's kind of what
a lot
I'm
of
saying.
these.
So if you're already doing the math and you're like, it ain't worth it. I'm sitting in the bank's shoes and thinking to myself, like, I have so many things I could be doing right now with my time and resources. Is this where I want to put bet the chips? Like, I can see why it's being slow, and I'm just asking Dean. You're more of an insider now than me on this stuff. Is it slow, or is it smart? Is what you said, meaning like methodically moving forward towards a vision, or is it more of a wait and see? Like, let's wait and see. Like, let's see if there's really demand here before we kind of keep going.
It is a great question, right? And I think as I've talked to banks, I see there's different answers to it. So there's a lot of banks out there who are taking the wait and see approach. Clearly, that's happening for every reason you just said. They've got a lot of things they've got to invest in. Is this one you really want to put your chips in right now? I think on the commercial side of the house is probably, and I know this is deviating from pay by bank a bit, but on the commercial side of the house, one of the things that's happening is there's a lot, instant payments specifically can change a value proposition for what the merchant provides to their customers. So there's a lot of tests happening out there to see where instant payments are going to make that value proposition something customers really want. As an example, and those, by the way, those tests are happening in places where us payment nerds haven't really even thought about them happening, but all of a sudden they're popping up. An example of that would be in prepaid wallet unloads, and specifically in the gaming industry, right? Mm-hmm. That particular model went from a pilot with one provider. 9 months after they piloted it, they won awards in the industry for innovative solution. 9 months after that, everybody was doing it. So basically proof of concept to table stakes, no pun intended with gaming, but proof of concept, table stakes in 18 months. If you were a corporate bank serving one of those customers and you weren't ready to participate, there's a good chance you were going to lose part of that corporate relationship.
If not all those deposits.
Correct.
So this is this is a disbursement, right? Like, this is a prepaid card that's funding a bet, and then a disbursement piece I have no questions about. Like, that makes sense, and I can see why that's gone really fast and has been super successful, frankly, like for the businesses that can originate a real-time payment. Like, I don't think there's a debate there. But the opposite is where I just don't see the same incentives applying to consumers.
So let me stick with the gaming idea, right? Yeah. So let's pretend that I love to do sports gambling, and
we're just pretending, right?
I suck at it. I donate my money when I do it. But like, let's say I like to do that, and there's a new service that comes out that doesn't have any record of me. I'm just saying as a new case, but I'm able to use a pay by bank to fund my account. Traditionally, if I had to use a credit card or an ACH, they would be restrictive on how much money I can put into that account. A lot of times what I've seen for me when I sign on to new accounts is I have a max of $500 that I can put in there. That's all I can put in there is $500. What the case of pay by bank, as we've described, where the consumer pushes the money to a merchant, I would be able to not increase my risk, but increase the ability to take in more cash as part of that service.
Yeah, and so that's that account funding, instant account funding is what that would equate to. And it exists in betting, it exists in investing, it exists in wallet loads, right? It's like, anytime when I'm trying to take my money and make it available to me in another, environment, I think it's a great example. Like, so instant funding and cards, there's the kind of de facto method for instant funding today. And I think would be a really good one to focus on. Like, that use case, I think does have legitimate fit. Like, the capability actually fits the problem.
Well, and then you get into the idea of gift cards as well. So anything that has some sort of value transfer.
To transfer value to a gift card. Is that what you're referring to?
Transfer value to a gift card.
That's what I generically refer to as account funding, like instant account funding. So you're not buying something. Could say you're buying a gift card. In that case, what we're saying is we're We're transferring value to another account.
You're buying bets when you do gaming, but
but first you're putting a balance in a betting platform, and then you choose how to place that bet. You don't just like spend the money like straight into a bet. Typically.
Yeah, I hear what you're saying. And I think I agree with you. Account funding is the next horizon where you're going to see more and more of the payments. And that's probably the stepping stone towards pay by bank, because that account funding is going to be based on that request for payment transaction. And that starts to get that infrastructure in place and people get used to it. And I think, the wallet loads is a good one. Brokerage accounts is probably the better one. The number of times where I've wanted to, load up my brokerage account to buy some stock, and I just can't do it as quickly or with as much money as I want with the current mechanisms. I think there's a great opportunity there.
So
when you start to get to pay by bank, it's me to me. Yep. When you start to get to me to the market,
to start.
Yeah, exactly. Back to that point about smart, safe, trying to work your way down the path. I do think where you're starting to hear, and at least what I'm starting to hear on the pay by bank interest is that merchant situation. I forget which one of you brought it up before about the merchant maybe not wanting to pay that interchange, charging consumers back for that interchange, which is happening more and more often. Then I'll put and I'm going to take that scenario and I'm going to put on my consumer hat as why I might want that as a consumer, or why a merchant may want it. If this is the first time I'm going to that merchant, well, having the card facilitate the transaction and the acceptance that goes with that and the protections that go with that probably makes a lot of sense. And that overhead for that interchange makes sense too, because you're making a payment happen, didn't know each other too well.
That trusted entity.
Yeah, it didn't exist. But now if I have a trusted entity, if I've been shopping some merchant, like the grocery store across the street, I go there, every week. I know the store manager. I know these people. They make my purchases. Well, do we really need to have all of that extra overhead that comes with a card transaction to facilitate that activity? No, that's where pay by bank can come into play, and I can make a payment. We can set up the right environment. I can pay them. Am I going to be returning my groceries? Maybe. But if I do, I'm going to be going to the front counter and complaining that this was rotten when I bought it, and they're going to take care of me because it's a trusted environment. So I think,
but you just hit on the two pieces that I talked about: trusted environment and essential services.
Yep.
Goods and services. Those are the two things that the comfort level of being able to pay by bank that's where it's going to take off. And then once everybody gets to that point, I think the next step is figuring out some sort of controls, as Matt was talking about, for the untrusted or unknown or unessentials to make sure that the protections are there. And maybe they never get there. Maybe it never goes that far. Yeah. But that's where I was seeing.
Yeah, where it takes time, right? It's a new payment network. You started with disbursements. There were certain use cases where high value and made sense. Then you get in these account to account transfers, and you get the account to account transfers funded by a request for payment. Well, that starts to make sense. And now you're building that foundational element to move into pay by bank. And then pay by bank goes to those trusted services, trusted relationships, the essential services, and you start to get more comfort and build things around that. And then you get to that next level of you can use it for anything. I think each one of those has investments that go with it. Each one of those has value propositions that go with it. Each one of them will make sense in certain environment, and there'll be situations where it doesn't make sense. And it becomes that very, nuanced situation. But I do think we're in the point right now where the testing and what's happening in those account to account loads is positioning us for that next level, that first level of pay by bank within those trusted services. And I suspect that, I don't have any inside information on this, but just what I pick up from conversations, I wouldn't be surprised to see some material movement on that in the next 12 months of organizations starting to test pay by bank who are in that trusted environment, who are in those essential services.
One of the things that I've been kind of mulling around in my head, where I think pay by bank could, if we could get the consumer behind it a little bit more, provide some sort of additional value that could be there, would be in the micro payments. So the $1, the $2, the vending machine, or I'm buying some digital good, getting in something that's a low value. And to me, low value is under $10, right? So if it's under $10, am I able to push that payment to the merchant? They may provide some additional value for that, but I think that's an area that could be one of the next steps beyond what we just talked about. I'd love to get your guys' perspective on that as well.
I'll jump in first. I tend to agree with you. I think because it's a low value payment, it overcomes the need to have a trusted relationship, right? It's $10. If you lose $10, painful, but not the end of the world. So it gets past that. I do think that there are some value added services that need to get brought into play to simplify the customer experience before that will take off. Right now, if I just were to describe that low value payment, if I was a merchant and you wanted to buy something for me for $5, well, you would start the purchase. I would then send you a request for payment. You would have to leave your purchase experience and go to your bank and approve that request for payment. Then the money comes back to me. And are you going to really want to invest that much time and energy for a $5 purchase? It's a great question. I don't know the answer. There are fintechs out there who are streamlining that process, making sure that approval happens within a session of a mobile session or an e-commerce session. As that technology comes to play, then yeah, I definitely see that becoming, those transactions becoming the type of transactions we'll see movement on. Matt, to your point, is this something that people are requesting and beating down the doors for right now? I don't know. I don't know if I've seen that. I think there's certain use cases that they will. It goes back, I go back to, and we all go back to the iPhone example, where people beating down the door for an iPhone, or, the Henry Ford example. You asked them what they wanted. They wanted a faster horse, not a car. Maybe there's some of that happening here too. I don't know. It's a lot of unknowns. If I could predict the future, I'd be rich. Living on the beach in Hawaii instead of, but that's not how the world works.
Yeah. I feel like you need to have a vending machine, a risk taker, somebody that's, prepared to take all the card terminals and NFC terminals off of their machine and put a QR code that says at the airport, right? Here's the QR code for you want to buy, whatever's in here. You like the goodies that are hiding behind this glass. You're thirsty. You're hungry. The only way to get it is go through this QR. Because I feel like if you've got a QR code and you've got Apple Pay and you can card swipe, I just don't see why you'd pull out your phone, log into online banking, find the QR camera, scan it, prove it. It's just like, I could just hold my phone up and it goes beep and now I get my stuff, right? There's Apple. It took a long time for Apple to get where it is now, right? A lot of detractors at the beginning were doubtful that Apple was ever going to reach critical mass, have enough, saturation coverage for it to be really usable. I don't know about you, but I often leave the house. I'd say most of the time I leave the house with no cards with me. I just have my phone and my car keys. And I rarely have a situation where that becomes a problem, right? So it's like, we just need to think the phone is the stand-in, and we already have capabilities that are quite good, right? They're expensive to the merchant. And arguably you could say that's expensive to consumers, but we've also seen that when merchants save money on card costs, like what happened with debit interchange regulation with Durbin.
Good old Durbin, girl.
Those savings do not come back to the consumer. And so I'm just sitting here as the person that's just trying to be practical, saying, well, if I'm not going to get the savings and I'm going to have to do more work, even one time, why would I do it? Right? I get it. It could be great. It'd be a great user experience if I didn't already have the ability to just hold up my phone and it buzzes and I get my stuff.
Well, and I think that comes into the whole user experience piece of it that we started off talking about at the beginning. Is it's got to be as easy, if not easier, than the methods that they have today to be able to use as a daily spend tool. It just has to be. How are we going to do? How is that going to be done?
I don't know.
Is it going to be
Ted? I think that the incentives can shift the amount of friction you're willing to accept. So there's an equation. I would say there's an equation that includes ease of use as part of it. But if my benefits vastly outweigh the cost of lower ease of use, I'll still probably be okay with something that is not as elegant if it's significantly better for me. For example, when I go to pay my property taxes, I have a choice to make, right? I can either get my account information, plug in the ACH, and I pay no fee. Or I have my debit card, credit card. They're linked to my, automated plug-in. Very simple. I can checking out is way easier to use a card than if I'm paying online. The price differential is so big that I say, no, it's not. It's not worth that. The convenience isn't worth that much money, right?
Right.
Because when you're paying property taxes, it's a big ticket, and 2.5%, 3% of whatever. I won't disclose how much I pay in taxes, but it's a lot. And
you do live in California.
I live in California, so yeah.
So we know it's not low.
Yeah, it's the same thing with like IRS taxes. Like you get to that checkout screen at the end. I always look just for because I'm always curious. Like, okay, this means I don't get a refund. That's true. I always owe, and then it's a huge amount. I'm like, that's crazy. I'd never pay that amount of money. And so I get it. Like I get why a merchant on the other side is looking at their own bills and thinking, that's a crazy amount of money. Why do I have to keep paying that? Right. And so the pressure to me seems to all be coming from the merchant. And the merchant has lots of reasons to want to change the dynamic, which I completely understand. The banks, I don't see as much of an incentive for them. I hear what you're saying, Ted. I think there's a story to be told there. I don't think it's super clear cut. And then consumers, again, I just don't see what is sufficient to change behavior at scale. You could around the edges, sure. Use case. Like there's going to be pockets where it makes sense. Broadly speaking, who knows what the future holds? To your point, Dean, like, I like that Henry Ford example. I think it's a good one. But again, we're looking at what happens now and like where to do some experiments, right? That's the kind of view that I take on these things is where can we experiment to go find out, right? Like where there is an underserved population where we put something in place and give them access to something that's really impactful. That would be really incredible. And your community banking story might be exactly the place to go look for that.
Yeah. Well, we were talking about cost savings for merchants. We're talking about reducing the dual pricing mechanism that's being used or surcharges that are being used as being two different options for this. But the one thing that we haven't talked about is how are the financial institutions that are receiving the interchange off of these card types going to monetize these bank to bank so that they don't lose that revenue? How are they going to monetize
lose that revenue? No, that revenue, that's the point. Like that's why I'm questioning the incentive structure because like the revenue that won't be there. It's how it works with Zelle. It's how it works with existing RTP flows. It's how it works with ACH. And so that's already at play, like with all the different methods of payment that are out there. And I do think that the biggest shift, I believe, is likely to come from increased regulation of card interchange. Like if the Credit Card Competition Act becomes real and credit card interchange starts to experience similar pressure as debit card interchange, I think you will see a lot of banks suddenly being interested in pay by bank in a way that they're not right now.
Yeah, I would agree with you. And I also think on the interchange front, some of the discussions going on right now about the lowering the cap on debit interchange are going to have some of similar effects because you get to a point where, the cost differential for providing those as a bank you might be just better off doing pay by bank versus a debit card as a bank at that point, especially if if you're impacted. I think from your perspective on where does a bank make money on this? Well, I guess two things. One, I think when you look at that, from a consumer perspective, it is about customer retention and acquisition right now, which is always, a soft dollar use case, if you would. It's real, but it's, sometimes it's a more challenging one to get through approvals. And I'll just give you an example. Again, I can't use pay by bank as an example specifically because Matt, as you said, that's not really out in the wild yet. But, if you take a look at one of the use cases that is really popular right now around instant payments, it's what they call earned wage access, or it's, real-time payroll. Right. And you've seen that in the gig economy, shift work, where in a gig economy, you're paid for the services you perform right at the end of it. So it could be at the end of your delivery, you get paid for it. Or shift work, you get paid when you're done working that day. For instant payments, that existed, but in order for you to get paid, you were either getting cash, which sometimes is good, but sometimes it's problematic. You were getting a check, Again, if you get a check at midnight when you get off your ship, what are you going to do with it? Or you were getting
Let's go party. Oh,
or you were getting ACH that came 2 days later, which kind of defeated the purpose of getting paid in real time. Instant payments now let you get paid immediately. It's creating use cases where people are going out and driving for Uber in the afternoon on Saturday to fund going out Saturday night. There's other budgetary use cases for people who have cash flow, go out and drive Uber to get some money or do whatever you need to do. The point I wanted to bring up though, and was getting to, is that we've seen stories of employees posting on bulletin boards which banks are participating and which banks aren't, right? Because those people who are the employees who are at banks who are participating in instant payments are getting their money in real time. Those ones that aren't are still getting stuck with all of those challenges I talked about before. And it's seen some switching of banks happening because of that. Is it huge material? No. But is it something that you start to see, wow, this is how this is playing out, that if you provide a better value proposition, people are willing to move banks to get that better value proposition off of a payment. So I think from a banking perspective, those that are in the space early have the opportunity to acquire customers because of it. Those who are late and laggards are going to have retention challenges. The other components that come in, deposits you mentioned, great case study on that was, Navy Federal, when they launched real-time payments back in December. They quoted that they received $2.7 million of incoming payments the first day. 2.7 million.
I was one of those people that sent money because I have an account there.
Okay.
Because I wanted to try. I mean, I'm a payments geek, a fintech geek, so I wanted to see how it worked.
And for the people who weren't just trying it, who are using it for some other services, 2.7 million sounds like a decent amount of money. Extrapolate that out 365 days. That's just short of $1 billion. Now that's real money. Well, where was that $1 billion going before they turned it on? I don't know. Was it coming in the Navy Federal a different way? Was it going to a different bank, different credit union? You don't know. So there's all of this stuff around the edges that there's business cases being built for it. I think a lot of it comes down to serving your customers, and as a bank, making sure you have the products that your customers want to use. You're enabling them to participate in the services that they want to use. And when you start to stack up the B2C disbursement use cases, which are taking off, the A2A use cases that are starting to take off, the pay by bank that's around the corner, banks are going to have to make investment in technology right now or sometime in the near future to play in this space and position themselves to be able to service our customers. And that's where I see the big, for the bank perspective and Matt's perspective of waiting. Banks don't want to wait a heck of a lot longer to get into the space because you don't want to be a laggard. You want to be as close to the front as you can where it makes sense for you. And I just see there's money to be made there, but you got to get into the space at the right time. Well, I just realized I was probably talking for like 3 minutes straight. Jared, can I get off my soapbox?
No worries, man.
So
it was all great information. But what I want to do is I want to close out today by just kind of giving our perspectives on what is the future of Pay by Bank. I know we've talked about a whole bunch of different things, but let's distill it down into our thoughts on what the future of Pay by Bank may look like in the next, let's keep it short. Let's just say 3 years. Matt, I'll start with you.
Thank you. So in the next 3 years, I think we're going to see experimentation on incentive models that merchants will be offering to convince consumers to try paying different ways. And we've seen it already starting. I think it's going to accelerate. So that's one. I think the second one is we're going to see more companies helping develop services to improve the experience when a consumer chooses to opt for a pay by bank transaction type. There'll be better ways to do that, right? There's already some that exist. We didn't really talk about them much here today, but like Trustly has a product, Plaid's developing a product, Stripe has a product. Like those are going to keep improving. The incentive piece is still going to, I think, be the key determinant for like where things go. And then I think what we've kind of talked about here, which is certain use cases are going to make a lot more sense than others. And I think we'll see concentrated use of capabilities in those use cases. And we talked about account loads. I think that's a really good one. we didn't really talk about this one, but I think it is critical, which is like urgent payments. These are usually for somebody whose services are potentially going to be interrupted because of prior lack of payment. And so an urgent payment to restart your phone, and utilities and whatever, right? Essential services. You mentioned that category, Ted. I would expect that to be an area that would have a real value prop for a consumer and would allow the banking industry to develop at least the core capabilities needed to facilitate the baseline transaction. So those would be my predictions.
I would agree with everything you said there. Only have really a couple of ads. And I think, in the financial services space, I think you'll see banks really, those who aren't participating in instant payments right now are going to start participating. You're going to see them with their strategies of how they want to participate, when, with whom. Even those who are participating right now and just are only receiving payments, they're going to realize the need to move into sending payments and being able to originate payments on behalf of their commercial customers and their consumer customers. So all of that will put those foundational elements in place to make pay by bank happen. And then, I also agree. I think you're going to see experimentation on certain use cases. And if what we've seen happen in instant payments in other places, like when I was talking about gaming wallets, I think you'll start to see some of that experimentation, find a use case that really takes off, and it's going to move faster than we think it will, faster than we've probably seen in payments in the past. Is it going to be mass market? Matt, I agree with you. I don't think it's a mass market thing that's going to happen in 3 years, but could we see specific use cases really light up and make materially? I think that's totally possible. That's kind of where I see about this.
Well, I mean, looking at just this year alone, I see us seeing more of these use cases being tried. The experimentation, Matt, that you mentioned, I think we're going to see this year have a ton of it, whether it be the middleware providers that you talked about, or whether it be additional banks coming on board. I think this year is the year of the experimentation. Wow, that was hard to say. Experimentation. This is the year of that. I think the following year after that is going to be sussing out how do we put the protections in place from all the things that happened during the experimentation phase. Yeah. And then the third one is how do we get the market and consumer adoption broaden that? How do we broaden that outside of that? And how do we expand the distribution channel? Because a lot of the things we've talked about is the distribution channel is the bank. And we know that with a lot of services that are out in the marketplace, you need distribution channels that are outside of the bank that are looking at things completely different. It could be the third-party service providers you talked about. It could be some of the traditional players. It could be brand new players. But I think that year 3 is really going to be about how does the distribution kick in? And then beyond that, it's just incremental adoption happens after that. So that's kind of the perspective that I'm looking at it from.
Makes sense. Yeah, that risk piece is critical. We didn't really talk a lot about that during the discussion, but I think that often goes, definitely like just as an example here we didn't talk a lot about that, right? I think actually that's one of the key features of because we like to focus on the tech, right? But one of the key features that's going to make it work is that people feel safe when they use it, and that they feel protected if something bad happens. And until they have that and they have a lived experience of like, okay, I can try this and I know I'm going to be okay. If somebody does something wrong and it's not me, I won't be responsible. Right. I think that is definitely a big area that will need to be unpacked.
And in that whole piece, we also have to think about it didn't work the way I expected it to. And so that they're going to want to have some sort of protections around, I expected it to work this way. You didn't tell me it wasn't going to work the way I was expecting to. How can you make me whole? Mm-hmm. And that comes in that trust piece of it, but it's not something nefarious happened or something happened that was intentionally bad. But this is like an unintentional consequence of not fully describing how.
It's like, I made a mistake. Help me recover from the thing. I screwed up. Help me fix it.
Like a decimal place was too far to the right type stuff.
And saying that too, it reminds you of a topic that we didn't cover on as well was the education side. And over the next 3 years, the industry is going to need to spend, invest in educating consumers and educating merchants as to how this is going to work. And I'll draw back to the days of debit as debit cards were coming to bear, and the amount of energy that Visa and MasterCard spent promoting zero liability protection. And we now call it zero liability because that's what they branded it when they promoted it and told people about it. But it provided that level of protection and the comfort. And there's going to be whatever that is in the pay by bank world, there's going to have to be that education of people. And that's going to be a big part over the next 3 years on top of the technology.
Well, guys, I appreciate you guys coming together with me on this one. Definitely had me challenging the way that I look at pay by bank and changed my definition, really, is what it did today. So I appreciate the insights and the contribution to the conversation. And I look forward to catching up with you guys later. So that's another episode of Fintech Uncut. If you haven't already, subscribe, like, share, all that fun stuff. And if you want to be notified about episodes as they come out, go to fintechconfidential.com/access, and you'll get notified as each episode comes out. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to GetHawkAI.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.